So, delayed briefing given the price action we've been getting off this downed Russian plane in Syria. So, really it's been a pretty interesting morning already, to say the least. It's only 9:20, and we've had a big wave lower as we've had a risk-off reaction to the still ongoing and developing events.
Excellent.
Turkey downing a Russian plane, Turkey saying the plane violated their airspace, they followed all the normal protocols, there was no response from the plane, so they shot it down. Russia saying the plane never left Syrian airspace. So definitely a diplomatic hot potato, to say the least. And given that we've had a significant ramp up in just general sort of geopolitical tensions and terrorist risk and military action in Syria, it's all adding to the mix. And given when you're looking at the S&P here, my top left chart, given we're trading up in just shy of all-time highs, then as those kind of risks materialize and escalate, does there need to be at least some risk premium baked into the equity markets? Because at the moment there isn't any. There's zero. The S&P is just shy of all-time highs. So we've definitely had a little bit of a panic this morning, except that as we hit 9 a.m., we got some pretty strong German IFO numbers, best number since sort of first half of 2014, indicating that the business climate conditions are positive, and that's even with the Paris terrorist attacks, the ongoing developments in Brussels, and just the general ramp up in fear across the European continent about terrorist activity. That even with that factored in, the German IFO number comes in at an 18-month high. Now, this is also a story that has been evolving and shaping over the last couple of weeks, really. But I'd say this week already, we've had two important data events from Europe. That one we've just seen, the German IFO 18-month high. Let me bring in a chart here of the European PMIs for November, preliminary readings yesterday, that ticked up to also a new 18-month high. Oh no, sorry, hang on, let me get this right. If I go back to a 5, sorry, that's not an 18-month high. Yeah, I had a problem with my chart. Trading Economics haven't updated it back past 2012, so it's at least, you're basically looking at a 5-6 year high, basically the highest level since the crisis, for roughly speaking, for this composite PMI, which is definitely used as an important indicator, lead indicator by investors. So this is quite significant. It does show that there is life in the European economy. These kind of PMI levels are typical of quarterly GDP growth of about 0.5%. So, whilst on the face of it, 0.5% is not, it's not like this economy's on fire here, but it's certainly better than any quarter we've seen since the crisis. So it's a signal that conditions are steadily improving. Now, add into the mix the comments from the ECB yesterday. Let me just get those comments for you, one sec. So these were comments from ECB's Lautenschlager. We've had pretty dovish comments of late. I would say, end of October, start of November, the ECB definitely ramped up their dovishness, and therefore expectations have grown and inflated as to what the ECB are going to do next week. Nicely summed up by RBS's expectation. They just announced this morning, RBS expect the ECB to not only cut the deposit rate by 20 basis points, but also to ramp up the QE program by increasing monthly purchases from 60 billion euros to 85 billion, plus also extend the program from its current endpoint, September 2016 through to March 2017, that's adding about 700 billion euros. Yeah, that's a substantial increase. This is RBS's expectations, which are very optimistic. So as a result of this, I think both, I should say, so that's the dovish developments, but expectations slightly getting reduced, and that was certainly helped along by Lautenschlager's comments yesterday. She said that she doesn't see any reason for further monetary policy measures, especially not for an extension of the purchase program. She said that data in the last few weeks indicates that the euro area economy has so far shown itself to be resistant to uncertainty in the global economy, and that we should give the numerous and all-in-all formidable monetary policy efforts time to show their full effects. So that is, well, certainly on today's kind of measures, very hawkish comments. When we're expecting rate cuts and QE extensions, then a comment like that certainly puts that view at risk. Add in the two strong bits of data, Eurozone PMI's multi-year high, German IFO number, 18-month high, then it gives us an interesting cocktail, an interesting mix. Then add in this Russian plane being shot down and the geopolitical factor ramping higher, and it's a pretty interesting cocktail, and actually a pretty difficult one. I think when you get momentum and risk off like we had this morning, when those events were unfolding, then, it's momentum that's pretty, well, it's obviously unidirectional and powerful, and it's those kind of momentum moves that if you can, quite aggressively get involved, then, profit expectations can be substantial. It's just then when you get a spanner thrown in the works by a very strong German IFO number, then it really complicates things and makes the trading of these events pretty difficult to interpret and to judge. So we've had, this big move lower on the DAX this morning, smashing down through 11,000, and we were trading lower anyway, on the back foot, and the Russian plane news, creating a big substantial move, and this is the rebound since the IFO number. So here we are on the DAX, actually back to have a little test of some resistance here. It's difficult though, because there's been a few resistance levels, and the DAX so far has moved up through all of them. So here's the next one, which is this low point that we had towards the close of the session last night at 11,027. It's a hard one to judge where resistance might be found and where this bounce might run out of steam and maybe we'll get going back on the downside. Very difficult to compare a geopolitical risk with an economic data event in terms of its significance and which one might have the overriding effect on markets. What you might say about the equity move here, whilst it is positive news, don't forget, it perhaps again downgrades people's expectations about QE extension, which could in the end turn into be a negative. So, I do still think that the right play here is to be patient and wait for this bounce to lose momentum, and then perhaps start looking for, short positioning for equities as we go into lunchtime. I think ultimately the geopolitical risk is still happening. We'll get more developments on this without doubt. But don't forget, good news could be bad news here for Europe or for European equities, given the fact that it, on the back of Lautenschlager's comments yesterday, it may well reduce market expectations of just how aggressive the ECB are prepared to be with their policy actions. For the S&P, we've bounced and we've hit yesterday's low. It's S1. We got a kind of 50% fib of today's range in around that area as well. But technically, for the S&P, anywhere around here, 2077, 2078 is good, solid resistance. the euro's been, well, let's talk about the Bund first. It's been sort of the exact opposite to stocks. We've had a powerful push higher when I just flick to a 5-minute chart for the Bund just to zoom in on this price action this morning. Finally, it took a while to get going, I have to say, for the Bund, but ultimately we then broke yesterday's high, and this triggered that powerful move as equities were pushing lower. The DAX hit the low of the day at 9 a.m. just before the data. This is when the Bund hit the high of the day, 158 handle, and then we pulled back. So a nice clean break out of yesterday's high. Easily the best trade on the Bund of the day was the classic long off yesterday's high that then went 30 plus ticks to hit the 158 handle. Then the iPhone numbers came in strong, and so naturally we've had a pullback, less expectation on QE. So you may well find that the Bund, well, I don't know, we're vulnerable to comments from Turkey and or Russia. So you've got to be very vigilant to that scenario as any updates come through. Okay, but I'd certainly, now that we've had a bounce on equities, I would be of the view that bounce is going to stabilize. We're going to lose momentum on the upside, and perhaps we're going to start steering back lower because less chance of QE, and we've got a geopolitical risk that's ramping higher. That'd be my view. Outside of this stuff, equities, bonds, currencies, if we just flick and have a look at the commodity space and just quickly touch on just quite an extraordinary session for crude oil yesterday, as we had Saudi Arabia making some comments. Of course, this is all ahead of next week's key OPEC meeting. Okay, it's going to be a massive week next week. The end of next week is huge. We've got an ECB press conference where we're going to see whether they cut rates and or extend QE. We've got the OPEC meeting, which the stakes have just been raised after Saudi Arabia yesterday. The Saudi Arabian press agency said that the government would do everything possible to ensure stability of oil market, and we got a substantial spike higher in the price of crude, a couple of bucks to the upside in short order off the back of that comment. And so not only ECB press conference, not only an OPEC meeting, but then the payrolls number, the final payrolls number before the Fed are expected to hike for the first time in nearly 10 years. So massive week next week. So just focusing in on crude oil here, big pop higher. There's definitely, well, obviously we're very, very low. Let me just go to a daily chart. Upside potential is very large if we get what we're not currently expecting. If we get OPEC turn around and actually cut production next week. Now, if that were to happen, then we've got a lot of upside. So that is definitely not priced in. The opposite is almost fully priced in. No cut to production is basically fully priced in. That's why we had a pretty strong knee-jerk, almost panic reaction to what was ultimately on the face of it was a comment that it's difficult to judge what they mean. I mean, they say they are prepared to use all measures necessary to ensure a stable oil market. That's what they said. It depends what your view is, but you would certainly say that increases the chances of them acting and cutting production. What they did say, though, is that they would work with all major oil producers, including non-OPEC producers, to ensure a stable oil market, which kind of reduces the potency of the comment, because ultimately, what are they implying there? Maybe are they trying to engineer the price higher, but only if all producing nations cut production? Well, the idea that OPEC are going to manage to persuade a sort of global a globally coordinated cut in production, I'd say that's fantasy land. You're not going to get US shale producers agreeing to cut production, I wouldn't say. So, I don't. It's hard to judge, is the point, on exactly what that comment means and exactly and precisely how does it change expectations for next week's meeting. I mean, you saw that in the price action yesterday in response to this, huge move higher. We were trading down on the lows, $40.40. We made a new 3-month low. Then we rallied from $40.40 straight up to $42.75. And technically, I mean, it couldn't have been more perfect in that we hit Friday's high. I mean, almost to the tick. I mean, we were 1 tick shy of Friday's high. And then you hit that price point, and then we reverse and sell off, a cool $1.7 back to test the 41 handle. From there, we turn and rally another $1.50 to the upside, and then we pull back and into the European close. We're back around pretty much unchanged for the day. I mean, quite an extraordinary session. The volatility range was almost 6%, and yet the price of crude oil closed almost unchanged. So, I'd say between now and the OPEC meeting, I'd say that puts a bottom to this move, this sell-off. I'd be very surprised if crude oil is going to trade down below $40 before the meeting next week. I think that one comment, at the least, has halted what's been a 3-week-long downtrend. Okay, that's what I think. I think the lower the year is safe. If we get to next week and the OPEC meeting, they very much stick to their guns. We're not cutting production. In fact, they've been doing the opposite. Let's be honest. They've been increasing production. Unless they cut production, then hang on. So before the meeting, I think the lower the year is safe. I don't think we're going to make a new low for the year. We might make a new low for the year post the meeting when they announce that they're not cutting production. They may do other things. We were talking about this here at the office yesterday. They might do a pseudo production cut. They might spin it by saying or announcing, or not even announcing, just kind of subtly going ahead with a oil production facility maintenance shutdown or something of that kind of nature, where they shut down one of their production facilities for, in inverted commas, maintenance purposes. So actually cutting production, but not cutting production for the reason of forcing the oil price higher. The official line is cutting production because of essential maintenance work. That might be a kind of halfway house here. But we'll see. As it stands, I think the comment yesterday has introduced some uncertainty. We didn't have that before. There was certainty that they were not going to cut production and the oversupply situation would continue, and that's been half the reason we've been getting this wave lower over the last couple of weeks. Of course, we've had demand risk, plus strong dollar helping with the move lower also, but now we have a bit of two-way uncertainty because of that comment. Whether it means they're going to cut production, though, I still think it's unlikely, but we'll see. Definitely interesting. Outside of this, other areas of the commodity space, big downside yesterday. Here's my monthly chart for copper. Again, just extending what's already been the feature of the last few months. New 6-year lows. Zinc yesterday made a 12-year low on zinc yesterday. Back to levels not seen since 2003. The LME commodity index trading down to levels not seen since April 2009. The dollar index trading up above 100 for the first time since April. So commodities getting squeezed still by a strong dollar, as we are now just 3 weeks away from a potential Fed rate hike. Also, the demand side risk, as let's be honest, the global economic situation remains fragile. Chinese growth is still a particular concern going into 2016. So, commodities certainly under pressure. So we've got a pretty interesting mix of stuff to think about, which certainly will make volatility increase, but doesn't necessarily make trading any easier. When you've got good European data and a slight switch to certainly a hawkish comment from the ECB added to the mix, making next week's meeting less certain. Are they going to deliver the stimulus we want them to or not? Add in then the obvious terrorist stroke geopolitical risks that have ramped higher substantially and are ongoing, added to this morning by Russia, the Russian plane getting shot down. You've got metals trading at 6, if not 10, if not 12-year lows. You've got oil price volatility created by a Saudi comment that creates uncertainty about what's going to happen at next week's meeting. So you've got volatility is back, that's for sure. So you've got to be careful. I think when momentum's there, you've got to trade it aggressively. But then when you start getting news flow that counters that direction, exactly what you've seen this morning, big heavy downside off the risk-off phase, followed by quite a sharp rebound off data. So trade the momentum when it's there, be patient when it's not. Easier said than done. But it looks like this equity bounce has run out of steam now. I think the S&P hitting yesterday's low and S1 has been a key resistance point we pulled back from. We're now below the low point that we had on Thursday. The DAX just creeping back below 11,000. Look, maybe the euro dollar to test the overnight high. So let's see what we get. The other thing about today, we've had the key data from this morning. Just to finish off with on the briefing here, let me just show you the data calendar and what we've got ahead of ourselves. Because from Europe this morning, that's pretty much it. And what we have this afternoon from the US is the GDP data. So let me just bring the data calendar in here. We've got the Q3 second reading for GDP. We've also got trade balance figures. We've also got some Case-Shiller house market index numbers. We've got some consumer confidence data. So a pretty packed out session this afternoon for data. Probably the GDP number may well grab the headlines. We're expecting a pretty decent bounce, or a revision higher, I should say, to 1.5%. If I show you the chart, the 1.5% print that was delivered a couple of weeks back for Q3, we're expecting it to get revised higher, but not necessarily for good reasons. It's going to get most likely revised higher because of a build-up in inventories in Q3, which is basically, we'll see a reversal of that in Q4. So if it is upgraded, it's really at the expense of Q4 growth. So don't necessarily expect markets to react positively to a strong GDP upgrade because of the reasons as to why it's been upgraded, which is basically stealing growth from the quarter that we're in now. So we'll tackle that one when we get there at 1:30. But for now, be very vigilant to any news flow from Turkey or from Russia. And we go from there. Interesting times. Thanks a lot.